Welcome back to another episode of the Real Talk Podcast. Today we are here with Ismael Romero, born and raised in Bakersfield, comes from a traditional background, just like any of us, like most of our guests here. Graduated from Cal State Bakersfield in finance and economics, and you're now a financial advisor and wealth manager for over 16 years with Romero Wealth Management. Welcome, Ish.
Thank you. Thank you for having me, Edgar. How are you doing?
Good, man. Good. Cannot complain.
That's great. I'm excited to listen and do this interview with you.
Yeah, well, it's not. I like to say it's not really an interview because I talk a lot.
Oh, okay.
Sometimes too much.
Yeah, but no, today I have a lot to learn, man. We've talked in the past, and for one reason or another, we kind of pushed this off, and my podcast stuff wasn't as legit as it is now. So so we'll get this going, man. So what's up, man? Where do you come from? Like, how did you get into your business? Did you work for somebody before you actually opened your business? I mean, let's dive deep into how you were growing up.
Yeah, really quick. So my how I got in the business, my dad, I remember as a kid, I was 16, 17, always going working on his rental properties. He was the kind of guy that bought rental properties and did all the work himself, right?
Okay.
Back in the day, and one day I was thinking about the numbers. I was like, okay, Dad, you bought it for this, and you're renting for this, and ran the expenses, and this is your rate of return, Dad. So very early on, I was interested in investing, rate of returns, and how your money works for you. So that's what really sparked my interest. So
how old are you?
I was like 16, 17.
And at that time, was there anybody that was already kind of like inspiring you?
Yeah, my uncle Pascual. He's an entrepreneur. He owns La Cabaña restaurant. He's a real estate broker with, I don't know if you guys know Carlos and Pascual at Solutions.
Okay. Yes.
Those guys. So he was an entrepreneur that kind of inspired me. He had the nice houses and took the nice vacations, and he's the one that inspired me. But I worked for him from 17 to like 21 at his restaurant as a server. So he's the one that kind of inspired me to be an entrepreneur. I was an entrepreneur myself. And at one time, like from 18 to 21, I was working. I remember I was cutting my buddy's hair from high school.
You're a barber?
A barber. I was, and back then, I was charging like $5. I remember. I was like, who pays $5 today?
His brother was charging $7 when we were.
So I was working I was barber. I was working at his restaurant, and I was working at Kern Schools as a teller at 18.
At the same time?
At the same time, bro.
Damn.
And going to school full time. So, I remember my only, free time was from 3 p.m. Sunday to the rest of the day, because I worked at the restaurant in the morning, cut hair Saturday morning, went to the restaurant Saturday night, worked Friday night, and then
were you a waiter at the restaurant?
Yeah, I was a waiter, yeah.
I've always said, man, successful people always have to wait tables. Or sell cars.
Yeah. No, and that's where I really learned to talk to people and make them laugh, and have a personality and a relationship.
What were you getting in tips a day back then? Do you remember?
Dude, I remember one time. Oh, this was like during the height of I remember there was a mortgage guy in 2006. He gave me like I remember $100 tip. But back then I think I was making like anywhere from on a Friday night, a little over $100 in tips plus the wage. But
yeah.
But I remember there was a mortgage guy, back in the mortgage boom back that we had
when they were
I was
getting creative with finances.
I was like 18, 19 years old, man. So I was just like, whoa, that $100,
Plus, what was the salary back then too?
It was I think it was like $575, $675.
So $100 was a big deal.
Yeah, it was a big deal. Yeah, and so I worked for him, and I was going to school full time, and then at some point, I was doing an internship. There was a financial advisor that came to my senior year finance class, and he said, "Hey, I'm looking for a guy that wanted to work with him." And so I was the teacher said, "Hey, look, who's your top?" Asked the teacher, "Who's your top student?" And it was me. So I went to work for him as an intern my senior year at a company called Morgan Stanley Smith Bar. I don't know if you guys have heard of it.
No,
it's an investment company.
It's still active right now?
Yeah. They're one of the largest in the country.
Oh, damn.
They're right there in the marketplace, right by Freddie's office.
Okay.
So I went to work for them for about a year. I graduated, that's really, I didn't really have clients then. I just learned the business and the technical aspect of the business, like how a stock works, how to value a stock, how to
as a senior in high school?
Yeah, senior in college.
In college,
yeah.
Okay. So your first internship was whenever you were a senior in college, not before then?
Yeah, no, not the. I mean, I was like working at Kern Schools.
Okay.
For a couple. I think I was only there for 3 or 4 months, and this opportunity came up, and I switched over. And then eventually I went to work. When I left Morgan Stanley, he actually offered me a job in the Bay Area, but for what he was paying me compared to the cost of living, it didn't pencil out. And my wife had already started teaching here, so she had her job teaching. I'm very proud of her, man. She started teaching at 21.
Damn.
And now she's a school administrator. So she's. I always tell people, young people, that you find yourself a good spouse, and it'll take you far. Like they're the rock of your relationship,
especially as an entrepreneur, right? Like
somebody that supports you. And,
yep.
Yeah,
so you have some bad months or something, and she can hold it down, and vice versa.
But I was not an entrepreneur till about 7 years ago. I was worked for a bank with the salary plus bonuses, but it wasn't until I think about 8 years ago. I told my dad, and I think a lot of people get pushback because I remember I told my dad, and at the time I think I was making like a $90,000 salary, and then with bonuses and everything was $120,000. That's a lot of money, 8 years ago.
Well, it's even good money now.
Yeah, even good money now, right? So I remember telling my dad, I'm gonna go on my own. I'm gonna do this. I'm gonna do that. He's like, no, mijo, no, don't. Like it's better to be safe. Better to be safe, and I think a lot of parents they do that because they care, but they're also withholding what the max capabilities.
Well, they want to keep you safe to what they like by what they know, right?
Exactly.
They don't know about. Well, actually, your dad would flip houses, so he knew what risk was.
Yeah, no, he buy and hold guy, but
okay.
But he but yeah, no, he understood that, like the opportunity there, and every time he would upgrade, he would keep the house. So when right when I left and became an entrepreneur, it was scary, dude. Like you go from 100,000 plus to zero.
How were you in savings?
I was always a good saver, man. Like I remember I bought my first mutual, because remember from 18 to 21, dude, I worked and saved. I didn't have time to spend money. I didn't have time to spend money, so I had saved about at the time it was like 70,000 on my own, just working and saving throughout those years. And that's what got, like I tell a lot of young people is that, build that foundation financially, because if you build it early, then when you're 30, 40, like you'll have freedom. Trust me. Yeah. And, so I bought my first mutual fund when I was 18. I wasn't even, actually I was 17 because my dad had a sign for me to. So, I mean, what 17-year-old like says, hey, I want to invest in the stock market. Right?
Yeah.
And that was me.
Especially back then, right? Right now, it might be a little more popular for because of the internet for people to get into.
Yeah. Back then, you used to actually have to go to an advisor. I remember I walked into the career schools. I, wanted to talk to a financial advisor, and I was only putting in like $2,000, bro. So think about it. Back then, they're like, usually their minimums are 100,000, 50,000, something like that. But she helped me out. I remember her name, Karina Marquez. She helped me out, put it in. And I think 7 years later, that same 2,000 became like 10,000 in 7 years. So, that's really. So I was always interested in investing, have my money work for me, and not me work for my money. That was kind of my what I enjoyed. And then let's see, where was I going? Did I answer your question?
I don't know. I'm lost in what you're explaining too. I'm really interested.
Yeah. We're just really plugged into your story. But
so so I worked as an employee, and then I became an entrepreneur, and I was nervous, but I said, hey, I'm gonna do this. I already had the mentality. Like even when I was an employee, I never took breaks or anything. I was because our structure was salary plus bonus, right? So
where do you think that comes from? You think it comes from you kind of were born with that mentality, or did you have a mentor that?
Well, I think my dad was my mentor. But what I learned from my dad is that when you come from nothing, and Gary Vee talks about immigrants are hard workers, right? Because they're poor, they come from nothing, they're more hungry, right?
Yeah.
So I think my dad coming here from Mexico, he was young, didn't have anything. He would tell me stories when he was a kid where he would go days without eating. So my dad has this fear of being poor. So that's why he worked, save, didn't know how to spend, right? So that translated over to me a little bit, not knowing. I didn't realize this until I was 30. One day my wife, I think I was right around 30. My wife was and I had saved 150,000 by that time, and my wife's like, babe, what's all this money for? You don't enjoy it. And then that's when it clicked, man. Like it clicked that, hey, what is this for? Like, I have to enjoy myself today and also make sure I'm saving for a rainy day. Yeah. And even today, dude, I have clients that I have to convince to spend money because they're extremely.
I wish I had that problem.
No, I mean, there's, but and then I have others that are making a lot of money, and then I can't convince them to save $1,000, right?
Yeah.
So there's both into the spectrum. So yeah, that's a little bit about my story. So everything that my wife and I built together.
So you think before that time in your life when she was like, "What do you want all that money in the bank for?" Because I'm assuming you said 150 grand, right?
Yeah.
And I'm assuming you had your investments also, or is that just money that you had sitting there?
Yeah, I had money in the investments. Now in 2000, I remember I was in 2009 when all the foreclosures were happening. I actually bought my house that I still live in now at the auction.
Okay.
Paid cash for it, and my dad loaned me a little bit to make it whole, and then I refinanced it, paid him back, and but yeah, I was I had to actually take the money out of the stock market and pay. I mean, knowing, but I wouldn't be able to buy the house at the auction with the mortgage, right? I had to pay cash for
sure.
It.
But when you refinance, you just put your money back into.
Yeah, exactly. Yeah. Refinanced, I put it on a 10-year loan, and then I paid my dad back, and then. But yeah,
what'd you buy at that time for?
What?
Like what price did you buy at that time?
Dude, I think I paid $105 for
right now
it's probably $450 maybe.
Yeah, that's what I was gonna say.
Yeah.
So, well, with that being said, that's a good way to kind of transition into it. Like, do you kind of put your money in a bunch of different places, or do you have it kind of centered in just one slot of investment?
I'm a third guy. So a third in the market, a third in financial assets, and a third in real estate. That's kind of what my forte is. Like, that's my strategy, and that's what I encourage others to do. But again, if you're in real estate, then I want you to have more real estate. If you're like me, I probably have a little bit more in stocks now. Market's down about 20%. So
but because the space, right?
Yeah. Like lately, recently I put more in the stock market because it's down 20, 25, 30% in some cases.
So the stock market.
I've reallocated money in there. More money, as a percentage of my total net worth has been more.
Well, you know how they say when the market's down in anything, but let's talk real estate. When the market's down is when you capitalize on those opportunities. Yeah. Same thing in the stocks.
Yeah. Same thing. Usually stocks are more of a leading indicator. So the stock market goes down first, and then everything else goes down after. So usually in an economic cycle, real estate is actually the last thing to go down.
Sure.
And it's also the stock market's also the first thing to recover, and then real estate
follows it up.
I mean, you could talk about, okay, so it goes from the stock market, and then it goes businesses start to reduce workforce, and then once the reduction of workforce, then you have then real estate. So,
and it's tied together because if people aren't working, then they can't afford homes.
It's all correlated, right?
So with what you've seen happen so far, what do you think is going to happen with real estate in the next 6 months?
I think maybe we could see a maybe 10% correction in prices just to revert back to the mean. When I say revert back to the mean, that means that there's income wise, there's a median income here, and in order for the average person to afford it, it needs to. Unless there's outside people coming from LA just overbidding,
which is what's been happening for the last 2 years.
Exactly. Right? So if that keeps happening, then real estate's going to keep going up.
Now, are you thinking that locally or kind of like on a state or federal level? Like
both. Yeah, I think as a national level, I think 10%. Like some areas are going to go could go up. Right, smaller. Like we're actually favorable here in the States because we're relatively cheap relative to the rest of the state. Yeah. People might want to move here. There could be more demand here. So, but places like Texas that went up, twice as much as they did in Bakersfield prices, I think those are going to probably revert back. Places like Austin and Tennessee, Dallas. Yeah, some of those areas are probably going to maybe you might see a 10, 15, 20%.
Would you consider that a crash?
No, it's more of a correction. Crash usually means a 30% or more, 20% or more decline in price from a $100,000 house to let's say 80,000. But a correction is more of a mild 10, 15%, and those are normal, right?
Yeah.
I don't think pullback, right?
Yeah, pullback. Yeah, it's just a small pullback because and it's all tied to the Fed, right? And we'll talk about the Fed and inflation and what they're doing to the economy and how they have more of an influence right now. in the economy. Than,
So we'll talk about the Fed and stocks and 401k and all that stuff right now. What I do want to get into is life insurance. So you do deal with life insurance, and I guess I don't really need to ask this, but I'm going to ask it anyway. Do you recommend everybody to have life insurance?
I think if you have somebody that depends on you for your income, whether it be a spouse or kids, if somebody depends on you for your income, you should have, I think, life insurance. I believe that you should. It's an important part of a financial plan. It's the foundation of a financial plan. You want to make sure, especially if you have a young family, you want to make sure that if, God forbid, something happened to you, like their legacy, their financial future is not going to be affected.
Yeah.
And then, especially if you're a one income household and your spouse doesn't work, then yeah, it's definitely at least the one person. So the foundation, that's the foundation of a financial.
So what about a single person that just lives at home with his parents? Do you think it'd still be a good idea to get life insurance?
I think if they're planning to get married and have kids and build a family, I think it'd be wise to start younger, because the younger you are, the cheaper it will be. And if you get a 30-year policy and you're 20, your payment, like for $1 million, your payment might be $15 a month, right? And me, like I would say, if you're single and let's say your parents, are of retirement age or close to retirement, and you don't think they have enough money to be able to retire comfortably, and having some would be ideal.
Yeah.
So I think if you're planning one day to have a family and everything, yes, I think because if you get it at 20, you're going to pay like $15 a month. If you get it at 30, you're going to pay $30 a month, right? So for $1 million term,
double.
Yeah. So you can start, the earlier you start, I think the better.
Now, if you get like you said 30-year term?
Yeah, 30.
Okay,
term.
so like if you get a 30-year term at 25, let's just say, and you're paying $25 a month or whatever, and then you have a family, you have kids, you have a spouse, your term doesn't change in 20 or 15, 20 years, right?
No,
it stays the same on 30 years.
For 20 years. And, after the 20 years, you don't have insurance. But by that time, hopefully you've built up some assets, built up some net worth that, and your kids are already out on their own in college. They don't depend on you. At that point, you don't really need the insurance.
Yeah,
unless it's important for you to leave a legacy of a cash asset, like, because you got to leave real estate, you can leave stocks. Life insurance creates a liquidity, right, where it's cash, right?
Yeah,
tax-free cash.
So like a baller like you doesn't need life insurance. No, I'm messing with you. But like somebody, let's say, billions in assets, like paid off, they don't need life insurance anymore.
They don't need it, but they leverage the tax laws of life insurance.
Okay.
There's ways to, and there's a little bit more complex stuff
to write it off and stuff like that.
To not only write it off, but also legacy for the generations and generations of. So, like I always recommend, you want to have at least maybe anywhere from 5 to 10% of your net worth in life insurance value.
Now that's permanent life insurance.
Permanent life insurance. Yeah.
Now, so
it's going to be the most conservative part of your portfolio.
Okay. Can you kind of briefly explain the difference between term and permanent?
Yeah. So term, basically think about it like car insurance. You pay. You don't, if you pay, this is insurance like car insurance. So if you don't die, you don't get anything, right? It's just cost of insurance. A permanent life insurance is actually an investment with the life insurance company. So think about banks and life insurance companies, right? Banks are, if you have $100,000 in the bank, they can leverage 10-1 that money and lend it out at 3% for a mortgage. Well, now 7% for a mortgage, 6%, or 15, 20, 30% for a credit card, right? So they make what is called the net interest income, right? The difference between what they pay you and what they charge others. And how do you participate in the bank? You buy stock in the bank, right?
Yep. Life
insurance work the opposite. We all pay into our policies, right? Life insurance have cash. They have all this money. They invest in investments. Real estate, businesses, private equity, hard money loans, a lot of different things. So basically, permanent life insurance, it allows you to tag along for the ride of the investments, but it's more conservative, right? So the returns are not going to be as great as the stock market or life insurance or real estate.
Now, I've heard this around multiple times, and something that I did want to kind of get more information on with you. So I heard something along the lines of you can invest into life insurance permanently, right? And then let's say you put in $100,000, and then you go and take out 50. The insurance company is still paying you on the 100, right? You're still getting interest on the 100,000.
And then the insurance company lends you the money, but you have to have a buildup of cash.
Now, so now you have a payment plan to pay them back what you. So let's just say, for example, I get a permanent life insurance policy, and my monthly investment is going to be $100, right? Or, I don't know, but let's just use that number. And then I start off with a lump sum of 20 grand. So I have 20, and then now I'm putting in 100 every $100 every month. So
you don't want to do that because the way the life insurance, in order to make it tax free, like a lot of people advertise, you have to make sure it looks like a life insurance policy, meaning you're making the same payment every month, right? Okay. So if you put in 20,000, you got to put in 20,000 every year.
Gotcha.
To make it it's called a modified endowment contract, the tax law of life insurance, and we structure those behind the scene. Like you don't
deal with it.
I don't really talk about the details unless somebody asks. But yeah, you have to make it look like a life insurance.
So because
the IRS is going to say, "Hey, is this an investment or a life insurance policy?"
Of course. Yeah. So let's just say that we do it the other way, right? Where we're doing $500 a month every month, every month,
6,000 a year.
Yeah,
for 10 years, you put in 60,000.
Okay, and then 6 years later, I go and borrow 50 grand.
Okay,
right.
So you have 60,000,
and I go take out 50.
50. Okay.
Is my payment still only $500? And now I only have 10 grand in there, and I'm pretty much starting over, or how does that work now?
No. What they do is they actually, when you borrow from it, the life insurance company gives you a loan against your policy, and then the 60,000 is still earning money, right? It depends on if the life insurance company structures the deal as a, and it has to be in the contract, because some life insurance companies don't, right? Once you borrow the money, they don't pay you on the investments. So you lend it, you borrow from them, and then usually your 60,000 still keeps tagging along for the right of the investments. So you
pretty much have a loan that you're paying back, and then you're still paying your 500 a month with your policy. Now, the reason that I asked this is because I got a pitch to me saying, send me your clients, we can help them save money, and then they can take that money out and use it to buy a house. And essentially they are getting paid on this other amount.
It's more efficient for somebody that's young to put into like a Roth IRA to do that, because life insurance upfront, there's an upfront commission. There's so like if you put in a policy for $500 a month, 6,000 a year, like the first year you put in 6,000, but your policy is only worth 1,000 or less.
So fees and commissions and stuff like that.
Yeah. So you really don't break even until, like, from what you put in and what it's worth. You don't break even until 10 years.
Oh, okay.
That's why it's not a good investment, right? It's if it's important for you to leave money to your kids tax free later, then that's worth it, because you're not going to like the policy's return in the beginning in the first 10 years.
It's a long term.
You're going to like it. You're going to like it 20, 30 years from now when you have it and you have permanent life insurance coverage.
Now, another thing that I hear a lot is too is like, well, this is like a pitch from an insurance agent, that they say like, hey, well, look, I'm gonna give you insurance for the next 25 years. If you don't die, I'll give you your money back.
Yeah, that's called a return of premium. Yeah,
so that's permanent as well.
Yeah, no, it's a return of premium policy. That just means that like if you bought a 30-year policy and just regular term, it would probably cost you $30 a month, right? If you want a return of premium policy, that same $1 million is going to cost you $150 a month. So the difference is that 30 of the 150 is going to go to the cost of insurance, and then the other portion is going to go to an investment account, and then they structure it to where you're in 30 years you're going to get what you put in back. So it's basically like a low interest account, like 3% account is what you're doing.
And
so
if you die, then you get your million or whatever.
Exactly. Tax free.
Okay.
So if you put in...
So would that be one of the better options that you would recommend to somebody like around our age, let's say 20, 25 years old?
Yeah, that's a good option.
Because we don't plan on dying in the next 30 years.
Yeah. So
right?
basically you get what you put in. So if you put in 30,000, at the end of the 30 years, you get 30,000 back.
Okay.
But that just means that you lent money to the insurance company, they invested it for you, and you got a little bit of return. So it comes out to like a 3 to 4% return.
So essentially, it's better to go the permanent route, because the investment. If you don't die, you're also going to have more money there to liquidate out, right?
Depends on what your goals are. If you tell me, hey, I want to have permanent coverage, or some people are like, oh, hey, I only need it for 30 years, and I don't want insurance because my real estate is making 20% a year, 10% a year, because life insurance is going to be a more conservative investment. unless you buy what is called a variable universal life policy, where you can get more aggressive with it.
Okay.
Most life insurance agents can't even sell it because you have to have your not only your life license, you have to have your investment license too. Because most agents sell either IULs or permanent whole life.
But if you're getting into that aggressiveness of investing, then there's probably better routes to take, right?
Yeah, I mean, the benefit of life insurance is the tax laws associated with it, right? That's why you do it. Just like a Roth IRA, right? A Roth IRA has huge tax benefits. Basically, you don't pay taxes when you put the money into a Roth IRA. But yeah, it just really depends on the situation. So I like to I look at your personality. You're more of a high risk guy.
Yeah.
Right? Like somebody else might be more conservative. I'm like in the middle personally.
Yeah.
So for you, I might say, hey, let's go a little bit more aggressive and do a variable universal life or IUL. That's probably more appropriate for you because the other one's going to be kind of boring. You're like, 6%. Yeah.
So that's kind of what you do is you kind of sit down, kind of consult someone. You're not an insurance salesperson or agent. You're not you kind of consult and figure out wealth management, right?
Yeah.
Like, how am I going to make you wealthy in a sense?
Yeah.
Cool.
It's a different business, but if you want to be a financial advisor, you have to incorporate everything. You have to incorporate taxes, real estate, investment, stocks and bonds, life insurance, term or permanent, or IUL or VUL or traditional. There's a lot of different things that you can do, but my job is to really understand the client, understand their goals, understand their personality, understand their financial situation today, and what's the most appropriate amount to put in that is going to be there for them when they need it.
Yeah, for sure.
So then the top three, because I know there's like 5 different types of life insurances, right? Mm-hmm. So would you say the top, the most popular ones are term, whole life, and which would be the third?
IUL, probably. IUL, whole life, and term.
Okay.
Yep.
And if in your experience, how hard is it to cash that out, when you die or whatever, for your family to cash it out? Has there ever been like, something like I get like whenever there's investigations about the spouse killing the other person or whatever. Yeah. But I mean, like, just let's say it's a legit, someone dies in a car accident.
Yeah. No, those are always 100%. Now, there's all the policy, all life insurance have a suicide clause. So if you commit suicide, you can't.
Okay.
You basically get all your money back. Your family gets all the money that you put in back.
But you don't get
the rest benefit. Yeah.
And then every single death gets investigated.
No, if it's an accident, it's obvious. They have a police report, they have this and that. All you really do is submit the death certificate to the insurance company. They
pay you out.
They pay
How
you
fast?
Out. If it's I have clients that I have some of my bigger life insurance policies that I've sold. The death benefits are 3 or 4 or 5 million. So they may do an investigation depending on the circumstances, right? If it's a car accident, like those are like
if there's a police report
there's no way. Now, if somebody dies of cancer and they didn't disclose that they had it in the underwriting process,
what if they didn't know they had it?
They didn't know they had it, then they didn't know they had it. But whatever they know, but usually like people will get declined if there was cancer history or something. So they won't allow you to get it. So they do a thorough underwriting background check on your medical history, and they'll take your blood labs and they'll look at any diseases that could be fatal.
So if I sign up for life insurance today and I don't have any health, well, everyone has health problems in some way, but I don't have like diabetes, I don't have cancer, I don't have any of that stuff, and then God forbid I have it 2 years later. Nothing changes, right?
No, you're still locked in.
And then medical records show that
after,
yeah. So then we're fine.
There's a 2-year contestability with more life insurance. So if you buy a policy now and you die within the 2 years, there's a little bit of a contestability period where you can kind of the insurance company. But after the 2 years,
But they still pay out if everything passes, and they still pay out even if it's 2 years.
Yeah.
Okay.
And then I heard there's a way you can kind of opt into. I think it's to take certain blood tests or do some type of diagnosis, right?
Yeah.
And I heard if let's say something negative comes up on your report, that like stays on you forever, right? So if you try to buy life insurance with anybody else, they're going to see whatever kind of medical kind of stuff you had going on.
Anytime you apply for a policy, they do that check. So
okay,
like any medical record that you had, like I'm working on right now, a guy that's putting in like $1,000 a month into his policy, and his wife had some type of EKG with the heart hospital, and they're investing. I mean, she's young and healthy. She just had a lot of stress at the time because she had a child with special needs, and she had a lot of stress at the time. So she actually had like anxiety attacks. She went to the heart hospital. She had EKG. So now the life insurance company is like asking 21 questions.
Yeah.
They're investigating it. They're asking her questions, and sometimes that happens, right?
But again, as long as everything pans out,
it's probably going to be approved because it was a temporary situation.
Yeah.
Yep.
And
They're just going to scrutinize it a little bit more before they say yes.
yeah, I actually,
And they might
Go ahead.
outsource the risk to a couple different insurance companies just to,
I forgot what my question was. I should have wrote it down. It was a good one. But actually, I remembered. So your boy's scared of needles.
Okay.
I told you this last time. They do offer non-medical
Yeah,
ones,
they do.
right?
Yeah, it's going to be a lower amount. Probably not, you're probably not be able to get 2 million. You might be able to get a 500,000, 200,000.
Okay.
So it depends on the life insurance company.
And then those,
It's going to be a little higher. So if you do like a full underwriting one, you might, for you, what, 30? How old are you?
27.
So you're 27.
No, 28. Am I 28?
So it might be $40 a month, right? Mm-hmm. If you do the full underwriting, if you want, let's say 500,000 with no underwriting, no nothing, it might be, $70 a month.
Mm-hmm.
So it just,
But like, let's say they don't do any medical stuff. They don't do any of that. But I die a year later from cancer and I had it when I got it. Do I still get paid out?
yes, like I said, there's a 2-year contestability. They have to investigate, but they're going to tell you no if there's like some history or some.
Yeah. So like, let's say medical records show that I had cancer on the day that I got the insurance. But I didn't. I got insurance with no medical for that reason. They won't pay it out, right? Because I knew I had it.
Those have different.
It gets complicated.
It gets more complicated.
Yeah,
On
but there's a chance that you don't
there's
get
a
paid
chance.
out.
Yeah, there's always
Gotcha.
a chance. Yeah.
Yeah, no, and my thing is just I really am scared of needles. Like, I hate, and I'm not the kind of guy that's just sitting there like, all right, do your thing. I'm like,
Yeah.
so that kind of ties in. So when you're investing into the life insurance policy, do you have any questions or anything else you want to touch on with the life insurance stuff?
No, I think we're good.
Okay, so you go into investing into life insurance, and you kind of mentioned that that's more of a lower return on your investment, or less risky investments, as you would say. But when there's less risk, that's why you said, well, I'm a higher risk kind of guy, because I've always thought that way. Like, if I'm gonna do something, I'm gonna do it. Like, I'm not gonna just try it.
Just your personality.
Yeah, that's just who I am. With that being said, though, it transitions into like investing into stocks and 401k and stuff like that. What's your thoughts on actually having a 401k set up?
I think if you work for a company that I don't know, like
Match?
let's say Grimway or Chevron, Era, all these companies that are private companies. I think if they match you, you're getting 100% return on your money. I mean, if you put in 6%, they give you 6%, and it's part of your compensation. So if you don't put money in the 401k where they're managing you, you're leaving 100% return on your money on the table. Not only that, but there's also the long-term average in the stock market is about 10 to 12% a year. So you're also not only leaving 100% return on your money, you're also leaving the 112, and then it compounds every year that you don't put money in. So I think I think it's a great investment to have. Most of my clients that I work with today have put money in their 401ks for 30 years. They've accumulated. I have clients that have anywhere from 500,000, and my top client has about 1.5 million in his 401k that he put in money in. Now that 1.5 million is taking care of him, right? That's going to be where the source of income comes from. He hires me to manage that money for him. So I buy stocks, I buy bonds. He's more of a middle risk guy.
Yeah.
So for him, I have 60% stocks, 40% bonds. Bonds, when I say bond, think about a loan, right? You're lending money to somebody, they're paying you interest.
It could be hard money. It could be any of
It
that.
could be hard money. It could be a mortgage bond. Like when you originate a bond, there's an investor on the other side, right?
Yeah, for sure.
Well, you can be that investor, right?
Yeah.
So that's what I do. I'm on the other side of the balance sheet. I'm looking at I'm investing their money in bonds and stocks. So
So a 401k, if I'm understanding you right, is highly, highly recommended when your employer is going to match you.
correct.
Now, if they're not going to match you anything, like it's what you do, then what do you recommend still taking the 401k route or going somewhere else?
I think if the main benefit that people don't talk about is that the 401k, it's an automated investment. You don't even think about it, right? It
just comes out of your check.
So if you're disciplined enough to save, then maybe not.
And it's tax free, right?
No.
It still gets taxed?
Yeah, it still gets taxed later at a lower tax bracket.
No, but I mean when it's coming out of your check.
It's tax deferred, so you don't get taxed on it when you come in
Until you get it.
Until you take it out when you're 59 and a half or retirement age. And that's what it's for. It's for to take care of the old you, right?
Yeah.
Some people believe, hey, what if I die tomorrow? Like, I don't want to invest.
Yeah.
That's the mentality. Well, that's fine. We're all responsible for our own decisions that we make, right? So, if you're 50 years old and you have to work until you're 80, or you're eating cat food,
you made when you were 30.
eating cat food at 70 because you never saved money, right?
Yeah.
But everybody has a different mentality, bro. Like I was like ultra conservative. Now, like okay, I want to enjoy, but I also want to make sure I'm saving.
Well, maybe that's why it was probably a good thing that you did that, because you went all those years saving. So now you're in a position where you could not be, if you wanted to, you didn't have to be conservative anymore.
Exactly. Yeah.
Right. So you're 100% right when you say do it when you're young, because you'll have time when you're 40.
Exactly.
Yeah.
Yes. So yeah, the 401k is always recommended. I think there's people that say that 401ks are not recommended. I'm not sure. I never understood why. I mean, I understand why. Usually they're life insurance people that only have life insurance license. So that's the only thing they can
sell.
They can.
So
sell.
they got to down talk what they can't sell.
Yeah, they got to down talk what they can sell. But I sell both. Well, I don't sell. I provide. So basically, my job is to understand the client's financial situation, tax situation, needs, goals, and personality. And then, so what I recommend is tied directly to what they tell me is important to them.
Yeah.
Right. So whether it be a stock, bond, or a Roth IRA, or a 401k, or a life insurance policy, right? It's based on what they tell me is important to them.
Yeah, for sure.
And then, so for example, if you do work like at a corporate company, like you said, Grimway, Chevron, and they're already kind of set up with the Roth IRA account, can they go to you and kind of you can handle that to like a different, for example, like a different.
When people
company?
are employed, I can't help them.
Okay.
I can. I'm just going to encourage them to put money in their 401k. Now, let's say they were with the company 20 years, and they leave the company. Now they have $250,000, $300,000 in their 401k, and they don't know what to do with it. Now they're no longer at this employer. That's when they can hire me, and I can invest the money for them.
Okay.
Did that answer your question?
Yeah.
So when you leave a job, this is a personal question. Mm-hmm. I was working somewhere and I was putting 3% into my 401k and they were matching it. And I left before it could even get to anything. I don't even know how much is in there, but honestly, it's still just there. Like, what happens there? What do I do? What's my step to take? It's not there? Much. Yeah, it's not much.
Well, I would just open an IRA and then roll it into an IRA. And I encourage you to learn about the stock market. Maybe buy, like I always tell people, hey, buy the companies that you use. Like, do you shop at Target? Yeah. Buy stock in Target. Do you buy stuff on Amazon?
Yeah.
Buy Amazon stock. Or do you own a Tesla?
Yep.
Buy Tesla stock.
Yeah.
You like Louis Vuitton? You can buy stock in Louis Vuitton. So there's
you're kind of emotionally attached to it as well,
correct.
Not just
Correct. Yeah. So anybody that's starting, so you can actually, but more importantly is that you can actually learn about how it works, right? And then eventually you can start. Most entrepreneurs, like for example, for me, I have to create my own retirement account because I'm self-employed, right?
Yeah.
You work with a company they're provided 401k, so they do it for you. So it really depends on. What's important to you. Taxes is an important thing that you have to. I recommend a little bit more for younger people Roth IRA and life insurance versus traditional IRA, just because if you look out 30 years from now, right? Do you think tax rates are going to be, with all the money that was printed on the debt that was given during COVID? Do you think tax rates are going to be higher in 30 years or lower?
Higher. Sure.
Yeah. So you want to have tax-free investments later.
Now on that same topic, in regards to like inflation and stuff like that, we were talking about earlier how inflation came down and it was official today, right? So that's going to help rates drop and whatnot. Mm-hmm. Stocks get either better or worse, whatever. What I'm getting at is, do you think how is it all tied together, right? So inflation comes down, rates come down, market does this, stocks do this. Like, is it kind of like, what does everything follow?
The Fed. So the Fed obviously has a big influence on short-term rates. Those are rates that banks lend to each other. So for the last 10 years, the Fed has been printing money, meaning creating more cash in the system, and also lowering rates, right? And they first started lowering rates in 2008 when the financial crisis to get the economy going, right? So So the Fed has more of an influence on the market, in the real estate market, in the economy than ever before. So the last 10 years, they've been lowering rates and printing money, right? Now they're doing the opposite. So what do you expect to happen? The opposite, right? Yeah. So if asset prices were up, 100%, well, they're not going to go down 100%, but they're going to come back to earth, right? And the reason, the main reason why the Fed doesn't like inflation is because, think about it, like if the Fed just said, hey, let inflation go 20% a year, think about what it would do to our dollars, right? What we could buy.
Your purchasing power goes down. Right?
Purchasing goes down. And there's going to be, I think if that happens, dude, if the Fed were to leave inflation at 20% a year, like just let it run, not increase rates, there's going to be people here that are middle class that are going to want to live elsewhere where it's cheaper, like Mexico, right? And that's horrible for our economy, right? Yeah. An example that we have is Venezuela.
That's what I was about to bring up,
Yeah, Venezuela is that, people, there was hyperinflation, like 80% a year, like, milk would go up 80%. And a lot of people left Venezuela, right? And now their real estate prices are down like 70% because there's no population. They all came to states, they all came different places all over the world. So that's the downside of inflation. You don't want inflation to be too hot because of that. Now, so the Fed is actually, now they're raising rates to cool that inflation rate. And today the news came out that they were expecting, let's say 8, and it only came at 7.5. I don't know the exact numbers. So that the market liked that, right? So the stock market and like I said, in the stock market and the real estate kind of have a big, they're very correlated, right? So the market anticipates that the Fed is going to, like tomorrow they're going to cut 75 basis points, but the market, now that the inflation report came out, the Fed might say, hey, we're only going to do 50 basis points, right? Because so they're very, and here's the crazy part. I've studied history, like in the 80s. What's happening right now happened in the 80s, where we had hyperinflation. Rates were higher, right? They started raising rates. During that time, I think what's going to happen is the inflation number is going to come out, let's say, too hot, and they're going to raise rates. Now the unemployment rate is going to start going up, right? Because you're going to start seeing layoffs, right?
Which is a good sign, right? Just to clarify.
It's a good. It's not.
Well, obviously not a good sign, but for what I mean is that
for
when
the inflation to come down to cool, yes,
yeah.
It is a good sign. Now, what's going to happen is I think once the unemployment rate starts to creep up, the Fed's going to say, okay, we're going to lower rates to help that. So there's going to be a lot of stop and go. The next 5 years, my guess is that there's going to be a lot of stop and go, and it's going to be data dependent. The Fed's going to depend on the data that they're getting, and then they're going to react. They're going to be more react accordingly. Yeah.
Now that what kind of trips me out is like, we were just talking about what minimum wage was back what 10 years ago, maybe
15 years ago. It was like $5.75, $6.75. Now it's like 15, I think.
Yeah. So 15 years later, it tripled pretty much. So do you think we can expect 15 years from now for it to triple as well? And that would be crazy. $45 an hour.
Most likely, yes.
You get what I'm saying?
Yeah. Most likely, yes.
Do you think there will ever be some type of economy correction to where like boom, and then we're back down to like the dollar's worth more again and stuff like that? You get what I'm saying?
I don't know if you remember Mexico revalued their currency in the 90s.
I was literally thinking that right now. Like literally right before I said that, I was like, well, I wanted to bring this up, but I didn't want to sound stupid. Where I was like, you think we'll ever be like Mexico, where you know how Mexico's like pesos, but you're talking like how much is this bag of chips, and it's like 35 pesos, and you're like, damn, right? But it's pesos. When you take your dollar, then it's worth nothing. But
exactly.
What I'm getting at though is, you think we'll get to a spot where like we're buying a bag of chips for $25? We're obviously making much more.
Maybe,
and stuff.
Yeah. It's all relative, right?
Yeah.
But the problem is that wages have stayed they're still going up, but they haven't went up at the price of real estate and other assets. So eventually that will revert back to the mean to normalize, and that could mean and it's crazy to say this, but like Mexico, they revalued their currency, right? They basically cut 3 zeros from the back of it, and it was bad for their economy, right? I think the Fed is going to be like, they have a mandate to have 2 to 3% inflation and or the unemployment rate at a reasonable 4 or 5% rate. But I think what's going to happen is the Fed is going to be okay with higher than average inflation for the future, for the next 10 years, 15 years. Because if they raise rates too much to get inflation back down at 2%, we're going to have 15% unemployment, 20% unemployment if that happens. I mean, that's in a worst case.
It trickles back to everything.
Exactly.
Right?
Yeah.
Rates are too high. No one could buy. Mortgage people are out the business. Real estate people are out the business. That means that gas is. It just.
Yeah.
It all ties.
So
together.
think about if the Fed keeps doing what they're doing, we're going to see 20% unemployment.
Yep.
But that's why they're going to be very careful how they communicate, and they're, in my opinion, I think they're going to adjust as the data comes out.
So what's happening right now? What we're seeing happening day to day, well, month to month. You think it's a good thing long term?
Yes.
Yeah, for sure.
I think what they're doing is a good thing long term. Like I said, they're just going to have to be comfortable with higher than average. We might start seeing 4 or 5% be normal, where it was 2%, right?
Yeah.
But remember, let's talk about deflation, because deflation is actually something that happened in 08, happened 2020 during the pandemic. Like, deflation is something that the Fed never will allow to create. They'll print as much money with deflation because it's hard to control once you start seeing deflation. So they're going to never allow to see deflation in any economy.
Well, that's a good topic to bring up. Is we usually say that what's the average inflation in the United States?
I'd say about 3%.
3%.
That's what they shoot for.
What is that? What they? Well, you said that's what they shoot for, but like in the last 2 years, it's been way higher than that,
8,
right?
9, yeah.
But that being said, when they say the national average inflation is 3 to 4% every year, right? Is that because it's controlled? Like, we have to inflate that much no matter what. So that being like what I'm trying to get at is we probably will never see deflation, right? Not never, but
Never say never, but
yeah, of course. Like, we shouldn't
impossible.
see deflation,
Not with the policies that how our system is built. We never should see,
and that's a good thing.
Yeah, I think it's a good thing. Yeah, because it keeps prices stable, things stable. Because when you see instability in prices, and then you start seeing, like in Venezuela, you have like people out, on the streets protesting, and and then there's chaos, civil wars, and everything kind of start from that. But yeah, no, I don't. But it's good to. But what they're going to be doing is they're just basically inflating the debt away, because remember, when there's inflation, their government debt looks smaller, right? Mm-hmm. Just like if you bought a house for $100,000 and now it's worth $150,000. Well, if the price inflates to $200,000, your $100,000 debt looks smaller, right? Yeah. So that's kind of the logic behind that. But
now people have the misconception that like houses the price starts to get corrected, right? So, we all know what houses are selling for 20, 25, 30, 50, $100,000 over sales price right now. For the most part, sellers are starting to cover closing costs a little bit more and stuff like that.
Yeah, normal.
And so like a house that was going for $360, a year ago will probably go for like $340, $325 right now.
Yeah.
And people have the misconception that means that there's deflation, right? Like, oh, see, inflation is not a thing because houses drop by this much. How is that wrong? Like,
that is if you take, let's say, June of this year to now, we have seen deflation.
But the beginning of the year was crazy. So
yeah. So, but it's always looked at it from a year over year. I mean, we're still up, right, from a year ago. But when you take the data from now, or let's say June to next June, we're going to see a little deflation. Well, I would call it a slowdown in inflation.
That's what we called. That's what we were calling it last time too.
Yeah.
So pretty much.
So it's a slowdown in inflation from a year ago, but if you look at it a year from now and it's still down, then that's considered deflation. But
gotcha.
Slower inflation is what I call it.
Gotcha.
Okay.
I thought you said but. Did you say but or did you say but?
No, I didn't say that. I guess I just want to let the audience know that what we're talking about, the CPI, which is a consumer price index, right? The consensus, what it was expected to be, was a 7.3, and it came in just 0.2 lower at 7.1, which was good news for the stock markets. Like you said, they had a green day. But I wanted to ask you, do you think this gives, I guess, like the Fed a reason to kind of ease up kind of on their tightening policy? And do you think because of that, that we're going to see kind of like a higher inflation towards the beginning of the year next year for 2023?
Yeah, I mean, the market anticipates, like today, the market was up. This morning when I got up, it was up like 1.5% because of the report, in hopes that the inflation rate. But now the market's back even when I looked at it just a second ago, because they're not convinced that the Fed's going to drop their 75 basis points to 50. Right? So right now it's going to be like this, dude. There's a lot of uncertainty.
You said you think 5 years? It's going to be back and forth like that?
Yeah, I think so. It's going to be back and forth like that. I would say for the next 5 years. And I'm just looking off history, right?
Yeah.
The history.
History repeats itself.
Yeah, so I mean, in the 80s, the mortgage rate got all the way up to 18%, I think, right? What was that? You guys remember that?
Yeah, but then people were buying. Well,
people were still buying and
same
selling.
thing.
Yeah, but obviously when rates. So what I tell people is interest rates typically, if you look at history, the last 200 years, they move in 30-year cycles. So they trend down for 30 years and they trend up for 30 years. Will that happen this time? I don't know. But if history repeats itself, it will.
You think we'll get back to 18?
No, I mean, I'm not saying it's impossible.
It can happen, but
if inflation, if next year we see numbers come out where they're 10%, 15%, then yes. So, but you just have to kind of pay attention to what's going on. You see gas prices going down. You see houses cooling off a little bit. So
now, does that at all mean like don't buy or hold off, or what do you think?
No, I think like if you're young and you have a family, like I always tell people, like if you're married and you have a kid on the way, you need to buy a house. It doesn't matter if prices are going up, down, or in circles. Just you have a family, you need a place to live. As long as get a payment that you can afford. I mean, don't go big. Like starter home, get a 3-bedroom, 2-bath, 1,500 square foot home, right? So yeah, that's just my opinion, right? I think if you're or even if you're a young guy that doesn't have a family and you want to buy a house, maybe live in one, rent the other 2 rooms. That's a good idea.
Even Airbnb some rooms.
Whatever. But I think it's always if you're ready for it and you're financially responsible, it's a good time to buy,
for sure.
No matter what the market's doing. Like I said, up, down, or in circles, it's a good time to buy.
It's a good time to buy when you're ready.
When you're ready, yeah.
Yeah. And so you're into real estate. You're into stocks yourself, right? You have investments in both. Do you have a preference between the two?
I would say I lean more towards stock because I understand it. I mean, real estate is easier to understand than stocks. But like I said, you can actually make more money in real estate because you can buy a property that's, you can buy it for a pretty good discount and then sell it and make a profit. And you have more control of it. But that takes work, right? That takes, you being out there negotiating.
Man hours and stuff.
Man hours and everything. So you can actually make more in real estate, build wealth faster in real estate because you have control of it and you buy it right, versus stocks, because stocks you don't have control. The only control you have is that you can analyze a company and see that it's undervalued, and then you invest in it, and then hope that the management of the companies are growing and being prudent with their money, and they're aligning their revenue with their expenses and a profit margin that's reasonable. So there's, and like I said, if you would have bought Apple like for $1,000 20 years ago, your $1,000 would be like 120,000 right now. Like it's crazy. But so yeah, just pay attention to where people are spending their money and where they're, what they're buying, because that's those things that you want to be investing in the future.
When you manage people's money, I know you talked about stocks and bonds, but do you also kind of invest their money into like any futures or indexes and stuff like that?
Futures contracts are more speculative and more aggressive. Indexes or ETFs, index funds, yeah. So I have a portfolio of index funds and I have a portfolio of stocks. So what I tell my clients, like, because most of my clients, they built their money, they save their money for 30 years. They have anywhere from $500,000 to $1.5 million. So I can't be taking risk with their money with like cryptocurrency or anything like that. I buy companies that have real revenue, real expenses, and real profits. Companies that you and I know, right? Like, for example, Home Depot, Walmart, let's see, in oil, Chevron, healthcare, we got United Healthcare, we got Cigna Healthcare. In IT, we have Microsoft, we have Amazon, Tesla. I mean, those are down right now. They're 50% in this year. Those are good opportunities.
It's because Elon bought Twitter.
Exactly. Yeah, he's not paying attention to it as much anymore and spending time with Twitter. And the market believes that and knows that, and that's why it's going down.
He's a smart ass dude, though. You don't think all of that has a strategy to it?
Exactly, yeah. Yeah. And then, you buy...
so right now is the time to buy Tesla stocks.
It could be, but yeah, I think if you look at it 4 or 5 years from now, yes.
You busy after this?
So like, again, like I put money in safe, I would call investments that make an average anywhere from 9 to 10% over like a 10-year period every year. So in 10 year, basically double your money in 10 years. through an economic cycle, right? So right now I've been a little bit more conservative this year because, again, the Fed they said they're going to start raising rates. So what's going to happen? Market's going to go down. So I was actually a little bit more conservative with my clients' money. So like today, like my clients are down maybe 9% for the year. Well, the stock market's down about anywhere from 15 to 16%. So I strategically took some of the money out of the market. And that way, because I knew this year is going to be still down, and then next year is probably going to be down. But there's ways to, like, for example, right now, you can buy a 3-month bond for 4.5%. So you put your money in for 3 months and you get 4.5%. That's unheard of, right? And that's because the yield curve is inverted, and there's better yield right now in the shorter term corporate, municipal, and treasury bonds than in the long, right? So it's all about managing risk. So what I do is I look at the risk and I put my clients' money in the investments that have the least amount of risk for the best return.
So you don't put any of your clients' money or personal money into crypto or NFTs?
No,
at all.
No.
Now, do you think you'll ever?
Actually, $1,000 I do.
Yeah. just to try it out.
Yeah, just to understand it. I did look into it thoroughly, deeply, and try to understand it as an investment. But it's not an investment. It's a commodity. It's think about a commodity like oil, right? Oil goes up and down, right? In value. There's an exchange for it. There's real value in cryptocurrency. It's basically, you mentioned UCUS, so it's an unfuckable ledger. So you can't mess with it, right? It's a ledger that it has to be verified, and no government or nothing can mess with it, right?
Yeah.
So there's real value. I look at it. It's software. It's a software.
You think we'll get to a point where dollar isn't a thing no more, and we're just doing crypto?
We could. It's not impossible, and that's where the value is. But I think more than likely, I think countries that are unbanked in the global financial system are that currency is actually valuable for them.
Now, if we're looking
them to exchange,
if we're looking into like a long-term thing, to where like, hey, well, I would be willing to put $5,000 into it and just let it sit there, hoping that someday the dollar goes away and we're all running on cryptocurrency. Which, the way that technology has been moving in these last 5 years, it's ridiculous, right? Mm-hmm. So I don't see that not happening, right? Like, I don't think it's impossible. I think it's actually more possible than impossible.
Yeah, and I think you're right, because let me tell you this, but I don't think it's going to be this year. I think it's going to be or in the next 5 years. I think when your generation has a bigger influence on the economy, so like say 26, once you're 56 or 46, and everybody believes it, right? Then it's going to become a reality. Right?
So if you just go and park your money there, forget about it, there's probably a good chance you don't lose it, right? Like in the 10, 15, 20, 30, 40 year span.
Once it becomes regulated, like you heard about the FTX guy, right? Sam Bankman-Fried.
Yeah, that's what I was about to ask you, if like you keep up with crypto and all the news.
Yeah, I do, because it's financial news, right? Yeah. So it's related. The fact that he did that's the reason the market went down in crypto, because there's less trust in the system, right? So there has to be regulation, and that's what they're talking about right now in Capitol Hill. They're talking about how to regulate it, how to make it a real asset. Like right now, it's you can pay taxes on it if you have a gain. So but it's not regulated like our industry. The stock market is regulated, right? Companies have to report. They have to report to the SEC. They have to report to the public. They don't, right? And that's how they were able to steal billions of dollars from investors, because they don't have no accountability to any. So it's like free game. So it's
a big risk, actually.
Yeah, it's a big risk.
Yeah. But the return could be big too.
I would stick to like the more well known, like Ethereum and Bitcoin, and
gotcha.
All these others are, I call them shit coins. Anybody can come up with it, and you're basically just putting money in a ledger,
a rug pull or something. Yeah. What do you think about the possibility of like that CBDC coming out, like the central bank digital currency?
Yeah, if you think about it, money is already digital, right? To me, money is already digital, right? Yeah. There's some kind of, like if you go to Mercado Latino, there's still cash, right? Yeah. But when was the last time you used cash?
No, it's actually pretty annoying going to a place that they don't take card.
Exactly. So it's I think we are already digital, right? Mostly, not 100%, but the question is, the Fed is preparing for if we go fully digital. That, but just know this: that the Fed and the Treasury, they have too much power. They're not going to allow a third party currency to come in and take over the dollar.
Yeah.
In my opinion, like if you think about it, if you think about the world economy, the dollar is 80% reserve, meaning that 80% of the money transferred between the world is dollars, right? Like you go to Mexico, they use dollars.
It's that
right?
big.
You go to South America, they still use dollars, right? Wow. You go to, but mostly like world trade is in dollars right now. There's the BRIC countries are trying to come up with their own. Like BRIC is Brazil, Russia, India, China. They want to come up with their own and go away from the dollar, but politically, the government's protecting that. Right? They're protecting that from that happening, and the politics of like what happened in Russia. Like Russia got cut off of the financial system. You can't buy Russian stock anymore. You can't do it's and the U.S. has enough power to do that, and a lot of influence in the international monetary policy. But yeah, I think the dollar is going to be probably here in our lifetime. There's a talk about one world currency that could be Bitcoin, but I don't think it's going to happen in our lifetime. I don't think the government will allow it.
Gotcha. And just a real quick last question. So, what happens with your for example, my stocks and stuff when I die?
So, if it's
still in there.
Think about it like real estate. Real estate and stocks are taxed at the same. Real estate is an asset. Stock is a piece of ownership in a business. So if you die, let's say you buy a house for $100,000, or you buy Apple for $100,000, and you die, and it's worth $500,000, right? Your kid or your spouse, let's say your kid, let's say you go before your spouse or whatever, vice versa. Your kid gets that house for that $500,000 house, and he sells it. He pays no taxes on it, right?
That's if it's
whether
in a
it's
trust
a
fund,
rental
right?
property, whether it's your primary residence, right?
That's if it's in a trust fund, right?
No,
no matter what.
No matter what. Yeah.
Okay.
It's called the step up in basis with taxes. So I think Joel's talked about it on his podcast. Or if you buy Apple stock and you bought it for $100,000 and it's worth $1 million now, and you die, your kid gets $1 million in the stock, and then if they sell it and get all the cash out, they don't pay taxes on it because they get a step up in basis. So, I actually had a client yesterday. He got money from one of his aunts, and the money, it was like $400,000 that came into his account. And the stock transferred over because she died, and the stock transferred over.
And you can help somebody with all that?
Yeah.
Awesome.
And then, so just to make sure, does like someone have to put the stocks in a will, in a trust?
No, you just put it in your individual name. Some clients do have trusts. Most of my clients have their money in an IRA, so individual retirement account. But I have some clients that have money just in their name with the beneficiary. So,
okay.
So like, let's say you have kids, or you have a spouse, right? You open an account in your name, put your spouse as beneficiary, and then your 3 kids contingent beneficiaries. So you don't need a trust. If on financial assets, you don't really need a trust. You just have to make sure you name beneficiaries.
Gotcha.
More complex clients that I have, they do name the trust as a beneficiary because they want to control the money later in life. They want to, like one guy's like, none of my kids are getting it till they're 30 and have a degree and have a job.
Yeah.
So you can make stipulations. The reason you have a trust is you're basically controlling the money in the grave, right? So no, none of the life insurance, financial assets. No, I don't. Just name who you want to inherit it. In real estate, it's a little different just because of how it works. You want to have a trust,
for sure,
because of the vesting and the laws around real estate.
For sure. So, where can people find you, Ish?
You can find me on social media, Ish Money Manager, on Instagram, and my number is 661-900-2058.
Awesome. And then you're willing and open to taking new clients?
Yeah, anybody. I'll talk to anybody. I'm building a team right now to help me with certain clients because I want to be spending my time with higher asset, higher net worth clients because that's where I kind of add more value. So I want to make sure I have time to do that, and then I want to be able to help younger, newer investors with partners.
Awesome. Well, it's great to have you here, man.
All right, thank you.
You have a good one.
All right, thanks, Ish.
Thank you.
That was